So, usually when you evaluate a company's financial health, you kind of expect basic laws of physics to apply.
Right, yeah. Simple cause and effect.
Exactly. Like if a business is aggressively growing its user base
Mm.
and they're dominating their sector and operating with like near perfect profit margins,
Its stock price is supposed to go up.
it goes up, right?
Yeah.
It's supposed to be simple, but I mean, we're looking at a market landscape right now that completely defies that logic.
It really does.
So today, for you all listening, we're doing a deep dive to unpack this massive, totally contradictory puzzle, which is Robinhood.
Yeah, it's the absolute definition of a market paradox right now. I mean,
Right.
the scoreboard is just completely detached from the game being played on the field.
And that is the core mystery we're trying to solve today.
Yeah.
Like, how can a company post absolute blockbuster financial fundamentals while its stock price is simultaneously trapped in this deep, just punishing correction?
That's a great question.
To really understand this, we have to start by looking at the raw financial engine of the company and then contrast that with what the actual stock ticker is doing. Because honestly, the disconnect is staggering.
Oh, it's completely wild.
I was looking at their trailing 12-month metrics, and Robinhood is posting 41.5% revenue growth.
Yeah, let that sink in for a second.
Right. For a company of their size, in a totally mature financial sector, that kind of top-line expansion is just highly unusual.
It's massive, but, it's not just the sheer volume of money they're bringing in. It's the brutal efficiency with which they are keeping it.
Yes. Oh my gosh, the gross margin. It's sitting at 95.21%.
Which is...
That number almost doesn't sound real to me.
Yeah,
I mean,
sure.
most tech companies would kill for a 70% margin.
Right, yeah. To understand how a 95% gross margin is physically possible, you really have to look at the underlying mechanics of their business model.
Unpack that a bit.
Sure. So legacy brokerages, they used to have massive overhead, right? Like physical branch locations, thousands of human advisors, all these manual clearing processes.
Lots of expensive stuff.
Exactly. But Robinhood is an entirely different species. They built this asset-light, purely digital infrastructure.
Right.
So once that software architecture is actually built and their automated clearinghouse is operational, the marginal cost to add one new user...
Or process like 1 million additional trades.
Exactly. It's essentially zero. The cost just vanishes.
And then they monetize that volume through payment for order flow, right? Routing those trades to market makers.
Yeah, which requires almost zero physical capital from Robinhood itself. It's just a hyper-efficient software engine.
And that efficiency just flows completely unimpeded right down to the bottom line. I mean, their net margins are sitting at 41.12%.
With earnings per share at $2.07.
Right. And furthermore, they're operating with a price-to-book ratio of about 9.1. Let's actually pause on that metric for a second just to ground this for the listener.
Sure, yeah. So if you were to liquidate a company, right? Just sell off every server, every desk, every physical asset they own.
Of a giant yard sale.
Right, a giant fire sale. That cash
Yeah.
value is the book value.
Right.
So a price-to-book ratio of 9.1 means the market is currently valuing Robinhood at 9 times the actual cash you'd get from that fire sale.
Wow.
It screams that investors are historically paying this heavy premium for their software moat and future growth expectations, not for any physical hardware.
And they're taking all that free cash flow and just aggressively reinvesting it, right?
Oh, totally.
Like, they are rolling out international expansions, rapidly integrating new asset classes into the app. Financially speaking, they are an absolute fortress.
Which makes the reality of their stock chart so jarring. Like, if you just looked at the technical price action without knowing the ticker symbol,
You would think they're doomed.
you'd assume this business was facing imminent bankruptcy.
It is a brutal chart. The stock is currently trading at $94.91.
Yeah.
That is down 38.3% from its 52-week high of $153.86, which it hit back in October of 2025.
It's a massive haircut.
It is. It actually dropped over 6.5% just in the latest trading session alone. Year to date, it's down 16.08%.
There is, a tiny glimmer of a technical bottoming formation over the last 13 weeks, returning about 7.3%.
Okay, a little bounce.
But yeah, the broader context is just this punishing, relentless downward trend.
Right, so let me use an analogy here. It's like a sports team that leads the league in literally every offensive and defensive statistic, but somehow they're on this massive losing streak.
That is exactly what it feels like. The underlying business is this flawless, high-performance engine operating at max efficiency, but the stock itself is essentially just rolling backward down a hill.
But looking at the technical analysis of how this sell-off is happening, there's a very peculiar detail in the data.
The volume.
Yes, the volume regime, meaning, the average number of shares actually changing hands during this massive drop, it's sitting at 0.7x.
Right.
It's significantly lower than average. So this isn't some chaotic rush for the exits.
And that is a really critical distinction to make. When a stock plummets on, say, 2 or 3 times its normal volume, you're witnessing institutional panic.
Like, get me out at any cost.
Exactly. It means massive funds are actively dumping millions of shares at whatever price they can get. That's called panic distribution.
Right.
But a 38% drop on 0.7x volume tells a completely different story. It just suggests a simple lack of buyers.
So it's more of an orderly retreat.
Yeah, exactly. There are no squeeze symptoms present in the technical data. It's just a slow bleed. The institutional sellers aren't stampeding out.
The buyers have just simply stepped away from the bid.
Yes, exactly.
Which honestly deepens the mystery. Because if you have a highly profitable cash-generating machine, why on earth are the buyers walking away?
Well, the answer lies in market sentiment, right? And the very real threats that are gathering around Robinhood's core user base.
Right, because markets do not trade on the trailing 12 months, they trade on the next 24.
Exactly. And the narrative surrounding Robinhood's next 24 months has become incredibly muddy.
So let's get into the bears at the gates, so to speak.
Let's start with the optics and the erosion of executive trust. You have situations like that recent hack of CEO Vlad Tenev's X account.
Oh, right, where it was hijacked to promote some fake meme coin.
Yeah. And, does a social media hack directly impact a 95% gross margin?
No, of course not.
But it fundamentally damages the psychological armor of a financial institution.
It absolutely does, because when your entire business model relies on retail investors trusting you to hold their life savings, well, security is your primary product. A breach like that, even on a personal third-party platform, it feeds directly into this bearish narrative that the leadership is just careless.
It does. And if we look at what the leadership is actually doing with their own shares, they aren't exactly signaling overwhelming confidence either.
Yeah, let's look at the insider flow. Over the last 90 days, the data shows a net negative of 9,771 shares sold.
Right.
We're looking at 69 individual sell transactions from insiders compared to only 31 buys.
No, we should add some context to that, to be fair. In the tech sector, executives receive a massive portion of their compensation in restricted stock units.
Right, RSUs.
Exactly. When those vest, they routinely sell shares automatically to cover massive tax liabilities or just to diversify their personal portfolios.
So they're not necessarily dumping because they think it's doomed.
Right. A net negative insider flow is not automatically a smoking gun.
True, but context definitely matters here. When you combine a 2-to-1 ratio of insider selling against a stock that has already plummeted 38% from its highs,
It warrants caution.
it certainly does. It does not send a signal to Wall Street that the executive suite believes this stock has hit rock bottom and is a screaming buy.
No, it doesn't. But honestly, the executive optics are secondary to the true existential threat weighing on this stock.
The competition.
Yes. The primary moat Robinhood built was this absolute, unshakable dominance over millennial and Gen Z retail investors. That demographic was their walled garden.
But today, that wall is totally under siege from aggressive new competitors. Let's talk about decentralized finance, or DeFi, first.
Yeah, DeFi is a huge factor here.
Platforms like Hyperliquid are starting to pull some serious attention. What do they actually offer that Robinhood just doesn't have?
Well, Hyperliquid and similar DeFi protocols offer totally transparent on-chain mechanics and self-custody.
Self-custody being the key word there.
Exactly. On Robinhood, you don't actually hold your crypto assets, Robinhood holds them for you.
Right, not your keys, not your coins.
Exactly. But DeFi allows users to connect a private wallet and trade directly out of liquidity pools. It completely cuts out the centralized middleman.
And then on the other flank, you have these centralized crypto-native exchanges like MEXC aggressively expanding their footprint too.
Yeah, they aren't just staying in the crypto lane anymore.
Right, they're moving into traditional equities and pre-IPO stock offerings. They're basically planting flags directly on Robinhood's home turf.
And the timing of this competitive invasion is incredibly dangerous for Robinhood right now because their core user base is currently bleeding capital.
Oh, this is the momentum crash we were looking at in the sources.
Yes, we are witnessing a severe momentum crash across the specific types of assets that YOLO retail traders heavily favor.
We see that term, momentum crash, thrown around a lot in the financial media. But what does that actually look like for, say, a 25-year-old trader sitting on their couch on a Tuesday afternoon?
Basically, it looks like rapid capital evaporation.
Yikes.
Yeah. A momentum crash occurs when highly speculative assets, stocks or tokens, driven primarily by social media hype, retail gamma squeezes, pure momentum rather than underlying cash flows.
When those just suddenly reverse course.
Exactly. The retail trader buys at the peak, assuming the trend will continue forever. But when the momentum finally breaks, institutional algorithms short the asset aggressively.
And instead of cutting their losses,
The retail trader holds on, waiting for a bounce.
the classic diamond hands strategy.
Yep. And the bounce just never materializes. Those out-of-the-money call options expire completely worthless. Their portfolio shrinks by 40, 50, even 70% in just a matter of weeks.
And in the brokerage business, that is fatal to your metrics. Because Robinhood's assets under custody, which is the total dollar value of the money in stocks parked on their platform.
It's directly tied to their users' net worth.
Right. So if a user loses half their portfolio in a momentum crash, their trading volume is going to plummet.
Exactly. You literally cannot generate transaction revenue from a user who has run out of money.
They're tapped out.
The total pie of active retail capital is shrinking. So when competitors like MEXC or Hyperliquid enter the space, they aren't just fighting Robinhood for new users.
They're fighting over a rapidly draining reservoir of active capital. Wait, hold on, though. Let me push back on this for a second.
Sure, go ahead.
I mean, I get the DeFi threat on paper, but let's look at the actual user behavior here. Setting up a crypto wallet, managing 12-word seed phrases, navigating fluctuating gas fees.
It's a lot.
It's a massive headache for the average person. Robinhood's entire genius was building this incredibly intuitive, gamified user interface that made trading frictionless.
It's true.
Changing brokerages is not like canceling Netflix to subscribe to Hulu. It involves tax documents, wire transfers, ACH clearing. Is a clunky DeFi app really going to break that kind of deeply ingrained brand loyalty?
The switching costs are a massive moat. You are absolutely right about that. Robinhood's user experience is still arguably the best in the world for a beginner.
Right.
However, you might be underestimating how quickly DeFi interfaces have evolved in just the last 2 years.
Really?
Yeah. They are heavily abstracting away the seed phrases and the gas fees. It's getting much smoother.
Okay, interesting.
But more importantly, brand loyalty evaporates when fees become an issue. If a retail trader is working with a much smaller, battered portfolio after a momentum crash, they become incredibly sensitive to the hidden costs of payment for order flow.
Oh, that makes sense. Every penny counts at that point.
Exactly. If a decentralized protocol offers them tighter spreads and direct access to liquidity, the financial incentive will eventually override the convenience of a pretty interface.
Wow, okay. So the YOLO equity trader is tapped out and aggressive new platforms are circling the wounded. It paints a deeply pessimistic picture for Robinhood's core business.
It does, but this is where the narrative takes a massive counterintuitive turn. Yeah, because while the retail equity side of the house is really suffering, we are looking at a global macroeconomic setup right now that might ironically save Robinhood's balance sheet.
Okay, let's unpack the macro paradox. So if the YOLO equities trader is tapped out, where does Robinhood turn for volume?
The geopolitical chaos.
Surprisingly, yes. And just to be totally clear to you listening, our goal here in this deep dive is just to impartially report on the economic ripple effects of these global events, not to take any political stance on the conflicts themselves.
Absolutely. We're just looking at the data.
Right. So we're seeing rapidly escalating geopolitical tensions, specifically the renewed U.S.-Iran conflict and physical blockades occurring in the Strait of Hormuz.
Right, which is huge for energy markets.
Exactly. Because 20% of the world's oil passes through that specific choke point, crude oil has suddenly surged above $100 a barrel.
Which acts as an immediate shock to the entire global energy supply chain. Every single product that needs to be manufactured or transported just became significantly more expensive overnight.
And you combine that geopolitical shock with severe climate disruptions. We're tracking record warm El Nino patterns that are currently causing severe droughts in major crop-producing regions.
So let's walk through the causality of that for a
Oh,
second.
okay.
The El Nino weather pattern disrupts agriculture, right? Causing yields of foundational crops like wheat and corn to just plummet. So global food supplies tighten.
Right.
At the exact same moment, the ships required to transport that food are paying massive premiums for $100 a barrel oil, or they're having to take massive expensive detours to avoid the Strait of Hormuz entirely.
So the cost to actually grow the food and the cost to ship the food both skyrocket simultaneously.
Exactly.
And that domino effect hits the consumer directly at the grocery store checkout line.
It reignites immediate, terrifying inflation fears. The average retail investor suddenly sees the purchasing power of their fiat currency dropping week by week.
So how does this actually save Robinhood? Like, why does chaos in the grocery store drive volume on a trading app?
Because of how the modern retail investor reacts to inflation.
Okay.
I mean, in the 1970s, people bought gold. Today, when traditional equity markets look unstable and fiat currency feels weak, a massive subset of retail flows rushes straight into cryptocurrency assets.
Because of the whole digital gold narrative?
Partly, yeah. It's the persistent narrative of Bitcoin acting as a decentralized hedge against government inflation.
But the other part is just pure, unadulterated speculation.
Yeah, exactly. Let's be real. When inflation is eating your savings at 5% a year, holding safe bonds yielding 4% means you are literally still losing money in real terms.
You're going backwards safely.
Right. So retail traders feel forced further out onto the risk curve. They start looking for extreme volatility.
Like assets that can jump 20% in a week.
Exactly, just to try and outpace that inflation. So they open their phones, they open Robinhood, and they frantically start trading Bitcoin and Ethereum.
And Robinhood generates a massive, highly profitable chunk of its revenue from the spreads on those exact crypto transactions.
Bingo. Extreme macro volatility boosts trading volumes for retail brokerages.
Wow.
If Robinhood's crypto transaction volume skyrockets because global tensions are driving users to trade digital assets, it could be the exact financial catalyst that this current bearish stock price is completely ignoring.
So Wall Street is so hyper-focused on the YOLO equities crash.
That they might be entirely missing a massive crypto volume boom happening quietly in the background.
So knowing these opposing forces, right, we have incredible 95% margins and macro chaos pushing crypto volume up on one side, but then they're battling DeFi threats and a battered equities trader dragging the platform down on the other.
It's tug of war.
How does this actually resolve in the coming months?
Well, the calendar is going to force the market to make a definitive choice pretty soon. We don't have to guess forever. The upcoming catalyst will basically reveal the truth.
Right, and the most immediate catalyst is the Q2 2026 earnings report. This is essentially the moment of truth.
It really is.
Wall Street will finally get to look past the narrative and see the actual plumbing of their transaction revenues. Like, they will see hard data on whether the YOLO trader momentum crash genuinely destroyed the quarter's revenue, or if that macro-driven crypto volatility swooped in and saved it.
The earnings report will act as the ultimate arbiter here. It will quantify exactly which side of the tug-of-war is actually winning.
And then, looking just slightly further out on the calendar, Robinhood is slated to present at TechCrunch Disrupt 2026.
Right. Specifically on the smart money stage.
Yes. And that stage explores the bleeding edge of fintech, payments, and artificial intelligence.
And that is a potential narrative pivot right there.
How so?
If leadership can unveil meaningful AI integration like perhaps utilizing large language models to offer personalized automated trading insights or hyper-advanced risk management tools directly in the retail app, they could instantly change the conversation.
Because it proves they're still innovating.
Exactly. If they can prove they are out-innovating the DeFi competitors rather than just, resting on their laurels, market sentiment will shift violently.
Which brings us to the ultimate calculation for anyone listening: risk versus reward. And this is where the valuation gets really compelling for this setup.
Let's talk numbers.
Right now, Robinhood is trading at a price to sales, or PS, ratio of 18.54 over the trailing 12 months.
To clarify that metric real quick, price to sales tells us exactly how much the broader market is willing to pay for every single dollar of revenue a company generates.
Okay.
Now, a multiple of 18.54 would be astronomically high for a traditional company, say, like a legacy car manufacturer.
Yeah.
But for a hyper-growth financial technology company operating with those 95% gross margins we discussed earlier, it is actually somewhat compressed.
Because the stock has already retraced 38.3% from its highs.
Precisely. The bad news is already known. The market has already punished the stock for the DeFi threat and the retail momentum crash.
So it's baked in.
We say those risks are priced in, exactly. And when a highly profitable stock is already beaten down like this, it creates what value investors call a margin of safety.
Meaning the downside risk is somewhat limited because expectations are already in the gutter.
Yeah.
But the upside potential is massive if they deliver even a slight positive surprise.
Right. If that Q2 earnings report shows that crypto volumes did indeed save the quarter, the stock has an incredible amount of room to run back up toward its previous highs.
So, synthesizing this entire puzzle for you, the listener. The setup we're looking at receives a bullish score of 6 out of 10 based on the source data.
Yep.
It sounds like this is presenting an asymmetric entry point for a short-term swing trade going into those Q2 earnings. But, and this is a big but, the entire thesis relies on those crypto volumes actually holding up during the quarter.
I agree completely with that assessment. Crypto is the absolute vital counterbalance to the retail equities crash right now. If the transaction data in Q2 proves that crypto volumes thrived in the face of macro chaos, this setup transitions. What starts as a short-term swing trade based on an earnings surprise could easily transform into a multi-quarter hold.
Because the fundamentals are just that strong.
Exactly. The underlying software engine of this business is simply too profitable and generating way too much free cash flow for the market to just ignore it forever.
It really is a masterclass in market dynamics. I mean, we started this deep dive looking at a complete paradox, and I feel like we've mapped out the reality beneath it.
Yeah, I think so.
Robinhood is fundamentally a highly profitable cash-generating growth machine, but it is currently masquerading as a struggling, distressed asset purely because of shifting retail sentiment and the looming shadow of DeFi competition.
And that is the crucial takeaway for anyone analyzing markets today. It is a perfect real-time example of how market sentiment, like the fear, the optics, the narratives, and the actual stock price, can temporarily detach completely from the underlying business fundamentals.
The company's balance sheet is doing one thing.
And the stock ticker is doing something else entirely. Learning to identify those specific moments of detachment, really understanding the mechanics of why the crowd is walking away, is exactly how you locate a true margin of safety in volatile technology names.
You have to look past the bleeding chart and understand the plumbing of the business.
It is entirely about finding the mechanical signal in the middle of all the emotional noise.
Well said.
Yeah.
But I want to leave you with one final kind of provocative thought to mull over on your own as we wrap up.
Okay, let's hear it.
Think about the overarching history and brand identity of this company. Robinhood built its entire empire on disrupting traditional, slow-moving finance.
Right.
Their foundational mission was literally to democratize trading, to tear down the exclusionary walls of Wall Street, and to remove the wealthy gatekeepers.
They were the ultimate renegade disruptors of the 2010s.
They were. But look at the landscape today. Decentralized, crypto-native exchanges like Hyperliquid are rising up. These DeFi platforms are utilizing blockchain technology to completely strip away the need for any corporate middleman. They offer true peer-to-peer trading without a central authority collecting payment for order flow.
Right, a totally trustless system.
So the lingering question is this. As these decentralized protocols become faster and easier to use, is Robinhood, the great renegade disruptor, slowly destined to become the very traditional, centralized, profit-extracting institution it originally set out to destroy?
Wow.
Will they inevitably become the new legacy gatekeeper that the next generation of investors has to tear down?
It is the beautiful, ruthless, and just inevitable cycle of innovation in financial technology, isn't it?
It really is. Thank you so much for joining us on this deep dive. Keep questioning the fundamentals, look for the mechanics beneath the narrative, and we will see you next time.